Look, I need to show you something that most people completely missed today. While the financial media was busy recycling the same talking points, inflation cooling, rate cuts coming soon, stocks climbing on hope instead of fundamentals, something far more important was happening underneath the surface. And it wasn't happening in equities. It wasn't happening in crypto. It was happening in silver. Not the paper price you see flashing on your screen, the real market. This isn't another silver rally. This isn't a technical breakout. This isn't retail speculation. What we're watching right now is the beginning of a structural failure in the silver market that only happens when suppression mechanisms stop working. And once that process starts, it doesn't reverse quietly. I've been watching precious metals for over a decade. I've seen silver spike and crash. I've seen false breakouts designed to lure in momentum traders before crushing them. I've watched margin hikes, paper dumping, coordinated sell-offs at thin liquidity hours. I've seen every trick used to keep silver contained. What's happening now is different. This move didn't start with excitement. It didn't start with headlines. It didn't start with retail piling in. It started with physical metal disappearing. And that's the one thing they cannot fake forever. Here's the reality the mainstream won't say out loud. Silver has been artificially cheap for years because it exists in two completely different markets that are pretending to be one. The paper market, futures contracts, unallocated accounts, ETFs, digital IOUs, and the physical market, bars, coins, industrial supply, deliverable inventory. As long as confidence exists, those two markets can coexist. Once confidence breaks, they separate violently. And right now, that separation is accelerating. You can see it in the premiums. You can see it in delivery delays. You can see it in the shrinking vault inventories. You can see it in the way physical buyers don't sell dips anymore. They're not trading. They're accumulating. That tells you something fundamental has changed. The official narrative will tell you silver is rising because of inflation, because of industrial demand, because of green energy, because of solar panels. Those things are true, but they're not the driver. They are the accelerant. The real driver is this. Confidence in paper promises is collapsing, and silver is the smallest market that can absorb capital flows without exploding higher. Silver is not like gold. Gold is a reserve asset. Silver is a pressure valve. And pressure valves don't move smoothly. They snap. Here's my core claim, and I want you to sit with it because everything else flows from this. Silver is no longer being priced as a commodity. It is being repriced as a monetary asset in a system that can no longer deliver on its promises. That's why the moves are becoming violent. That's why volatility is increasing. That's why suppression is failing. The silver market is simply too small to contain what's coming. Let's talk about scale for a moment, because this is where most people don't understand how fragile this really is. The entire annual global silver supply is worth less than a single large tech company. Let that sink in. Trillions of dollars slosh around global markets every day, and silver is expected to absorb demand quietly at under $100 an ounce. That assumption only works if nobody panics, if nobody demands delivery, if nobody questions the paper claims. That era is ending. Industrial users are locking in supply because they have to. You can't build solar panels, electronics, medical equipment, or defense systems without silver. They don't have the luxury of waiting for prices to come down. They need metal, not contracts. At the same time, investors who actually understand monetary history are moving out of bonds, out of cash, and out of paper claims. That depend on counterparty trust. And where does that money go? It goes where it always goes at the end of debt cycles, into hard assets, into things that can't be printed, into things that don't default. Gold absorbs quietly, silver explodes. Now here is the part that should make you very uncomfortable if you relying on paper exposure. The silver futures market trades multiples of annual global production every single year. There are far more paper ounces promised than physical ounces that exist. That works until it doesn't. And once enough participants decide they want the metal instead of the cash settlement, the system breaks, not gradually, instantly. This is why silver doesn't move like other assets. It stays suppressed for years, lulling people into thinking nothing will ever happen, and then it reprices in months. We've seen this movie before, 1979, 2011, and now the setup is even more extreme. Back then, industrial demand was lower, debt levels were lower, leverage was lower, confidence was higher. Today, everything is inverted. Debt is everywhere. Trust is gone. And silver inventories are thinner than ever. And the most important part? The people buying now are not planning to sell back into the system. They want out of it. That's why I keep saying the screen is lying to you. The quoted price is a paper compromise between buyers who want delivery and institutions that desperately want to avoid it. But compromises break when pressure rises. And pressure is rising everywhere at once. Bond markets are cracking. Currencies are being quietly debased. Central banks are trapped. And silver is doing what it always does when the math stops working. It's telling the truth before the narrative changes. Most people won't pay attention until silver crosses a psychological level that forces them to. 90, 100, 110. Somewhere in there, disbelief turns into panic. But by then, The physical market will already be gone. Dealers won't hedge. Mints won't guarantee delivery times. Premiums won't make sense. And paper prices will lag reality. That's not speculation. That's how shortages behave. Silver is not warning you. It's positioning without you. And the only question left is whether you understand the signal before it becomes obvious. The reason silver is so dangerous to the system is the same reason it's been suppressed for decades. It's not because it's shiny. It's not because it's volatile. It's because silver sits at the intersection of money and industry, and that makes it impossible to control once confidence starts to crack. Gold can be hoarded. Gold can sit in vaults. Gold can be rehypothecated quietly between central banks without disrupting the real economy. Silver can't. Silver gets consumed, it gets melted, it gets turned into solar panels, circuit boards, medical instruments, weapon systems. Once it's gone, it's gone. And that's the flaw in the entire suppression structure. For years, the system relied on the assumption that silver would always come back to the market, that investors would sell into rallies, that industrial users would tolerate just-in-time supply chains, that paper contracts could always be rolled instead of settled. That assumption is breaking. You can see it in how industrial buyers are behaving. They're no longer price sensitive in the way they used to be. They're supply sensitive. If you're a manufacturer and you need silver to keep production lines running, you don't care if it's $90 or $100. You care if you can get it at all. That changes everything. At the same time, investors who understand monetary history are no longer willing to hold promises. They watched banks fail. They watched deposits get frozen. They watched bond portfolios implode. They watched risk-free assets become anything but. So they're doing what rational actors always do in late-stage systems. They're opting out. And silver is the smallest door everyone is trying to squeeze through at the same time. This is where the paper market starts to fracture. The futures exchanges exist to provide liquidity, not truth. They work beautifully when most participants are speculating and very few demand delivery. The moment that ratio shifts, the entire structure becomes unstable. Right now, open interest in silver futures represents a claim on many times the amount of physical metal actually registered for delivery. That's not a conspiracy. That's how leverage works. It's fine as long as trust exists. But trust is evaporating. And here's the thing most people don't understand. The exchange doesn't need everyone to demand delivery for the system to break. It only needs a small percentage to insist on metal instead of cash. Because once a few large players stand for delivery, everyone else starts doing the math. And that's when the scramble begins. This is why margin hikes are such an important tell. When exchanges raise margin requirements aggressively during a silver rally, they'll say it's about volatility. They'll say it's about protecting the market. But in reality, it's about slowing demand and forcing weak hands out before delivery pressure becomes unmanageable. Margin hikes are not a sign of control. They're a sign of stress. If the market were healthy, it wouldn't need emergency measures to function. And we're already seeing the early stages of this playbook. Volatility spikes, margin changes, sudden sell-offs during low liquidity hours. These are not random events. They're defensive maneuvers. But defenses only work when the attacker is small. The problem now is that the attacker isn't a group. It's a condition. It's the loss of faith in paper systems. You can't regulate that away. You can't suppress it indefinitely. You can only delay it. And delay always increases the eventual move. Let's talk about the short side for a moment, because this is where things get truly explosive. The bullion banks that dominate the silver futures market have carried massive short positions for years. That suppression worked because they could roll contracts, manage exposure, and rely on a steady stream of selling into rallies. But shorts have one fatal flaw. Their risk is theoretically unlimited. As silver rises, their losses compound. At first, it's manageable. Then it's uncomfortable. Then it becomes existential. At a certain price level, the risk managers step in. At another level, the credit committees step in. And at a final level, positions are closed regardless of price. That's when price discovery stops being orderly. This is why silver doesn't top gently. It overshoots. It squeezes. It moves in days what other assets move in years. We're not at that point yet. But we're close enough that the behavior has changed. You can feel it in the tape. You can see it in the intraday swings. You can see it in how quickly dips get bought. That's not retail enthusiasm. That's stress. Now, let's layer in the macro backdrop, because silver doesn't move in isolation. It moves when the broader system becomes unstable. Bond markets around the world are under pressure. Decades of suppressed yields created leverage everywhere. Pension funds, insurance companies, governments, corporations. The entire system was built on the assumption that rates would stay low forever. That assumption is dead. As yields rise, the value of existing bonds collapses. That creates losses that can't be ignored. And when institutions are forced to sell bonds, they look for somewhere to park capital that doesn't carry the same risk. Stocks are expensive. Real estate is illiquid. Cash is being debased. That leaves hard assets. Gold absorbs the first wave. Silver catches the second. And the second wave is always more violent. What makes this moment particularly dangerous is that silver's supply is not elastic. You can't ramp up production quickly. Mining projects take years. Permitting takes years. Capital investment takes years. Demand, on the other hand, can change overnight. That asymmetry is what creates parabolic moves. If just a small fraction of global capital decides silver is no longer optional, the price has to rise until demand is destroyed. And demand won't be destroyed easily because industrial users can't simply stop consuming silver. So the adjustment comes through price, violent price. And here's where psychology takes over. For years, silver has been dismissed as boring, manipulated, dead money. That narrative kept people away. It kept positioning light. It kept complacency high. When that narrative breaks, it breaks fast. People who ignored silver at 20, ignored it at 30, ignored it at 50, start paying attention at 90. And when it crosses triple digits, disbelief turns into urgency. That's when late money shows up. That's when volatility spikes. That's when mistakes get made. But by then, the groundwork has already been laid. The smart money doesn't chase. It positions early and waits. And that's what's happening now. Silver is not moving because people are excited. It's moving because people are afraid to be unprotected. And fear doesn't ask for permission. It just moves.